Welcome to the Chameleon Club. In this video, you will see a chameleon scalping case study. The trade ideas you're about to see are taken by following a trading strategy using the Chameleon chart software. The segment shown in this session is sped up and played back from a seemingly random piece of history on the BTC 5-minute chart. Disclaimer. If you make any financial decision on the basis of this video alone, you will likely suffer a loss. This video is for educational purposes only. Its main purpose is to show how the software can help navigate a path during a choppy period of range-bound price action. The trades shown were not made in reality. You will certainly not achieve the same results. In order to proceed with this case study for yourself, you will need to understand proper risk management. This means every trade has a stop loss. Every trade has a fixed, hard, definite stop loss that's placed onto the exchange, which amounts to 1% of your sub-account. You need to have a basic understanding of support and resistance, what it means to retest a level, how price will bounce between support and resistance levels, and how once the level's been broken through, that retest of that level is a useful place to position a stop limit order. You need to understand the chameleon colors. There are 8 or 9 that are important to learn, and these can be learned from the videos on the YouTube channel. And you need to have fluidity with the chameleon strategies. To get started, you need to add the indicators and study the chameleon training material. This can take 3 to 6 hours. Secondly, practice with bar replay and the long and short position tools. Third, create a new sub-account with $100 in it, or even safer, open the paper trading panel in TradingView. Chameleon tail indicator adds a filter. This is represented by a red or green arrow above or below the chart. Look for shorts when the arrow is pointing down. Look for longs when the arrow is pointing up. Chameleon indicator colors the price bars based on price action. It adds orange crosses to help visualize support and resistance created by pivot ranges and many other visual clues. The context indicator is shown above the price chart. Arrows signify that a range can be drawn around this time in the chart area. This range is drawn by taking the first extremity after a move down. Let's get started. As price retraces, this gives us the second boundary of the range high. This is drawn with the fib retracement tool. Price closed above the pivot range for the first time. Range high is nearby and is feasible by the most recent sweep of the range low 4 candles earlier to the downside. A tight stop just below the pivot high makes this trade feasible. +2R. This range trade is triggered by a limit short order. The stop is calculated using the yellow candle over 22.25. Target is the mid-range plus 2.2R. The next part of this move happens quite fast, is without a retest of the mid-range. Another possibility would be to leave half of the previous trade running and trail the stop down. When the candle wicks to the range bottom, a long limit is feasible, with the previous yellow candle providing the stop limit. And now a yellow candle offers a chance to reduce the risk before the target is hit. 1.4R. These grey candles show that the price is neutral, indecisive, hugging the mid-range value. No trade. Until price closes above the pivot range. Set a limit long on the retest of resistance. In this case, the 0.786 fib level. And now price reaches the range high. The target is hit plus 2R. Prices broke through the VWAP resistance, retested the VWAP line, the yellow line, and has closed above a pivot range. We can set a limit order. A new pivot suggests downside bias. Move the stop in to reduce the risk to 0.5. As traders, our main job is to manage risk. Green triangles are cycle up signals. When these appear in our long trade, keep half of the trade active. Increase the target and move the stop to break even for the remainder. Then move the stop to the original target when it makes sense to do so. Plus 0.7R, and the other half is still running at this point. The stop is trailed up, and eventually the other half finally gets stopped out before reaching the new target. Plus 1R for this half. Combining both elements of this trade generates 1.7R. In summary then, 7 out of 7 winning trades within and around this range, with a running total of 9.3R over a period of 4 hours of trading.